Hello, my friends. Brett Pattison coming at you from the financial capital of the West. That is Salt Lake City, Utah. Thanks for taking a few minutes of your day today to listen to some important information about the month of July, August, September, and so on. Every summer seems to have its own roller coaster ride. That's what we're going to address today. What's happening in the markets? What should we expect? And what other pieces of advice do we have as Iron Gate Global Advisors to you, the investor? And we always really start with this. This is the process for investing that we have. This is just a checkpoint, right? A psychological checkpoint to make sure that we're doing the right things. And we always focus on at Iron Gate Global the process for investing. We're not results driven. We don't seek returns. But yet we focus on the probabilities of making money. Those investments with a higher probability of winning than losing, whether it be buying good stocks at good prices, whether it be options trading, or whether it be ETFs. That's the primary focus. We know that if we do that, the returns will ultimately come. So we're not return chasers, and we don't ever change our process to chase returns. So that said, let's take a look at the historical S&P 500 averages. Now, we bring this up because one thing that helps us understand the market moving forward is to understand how it's reacted in the past. And so we study history. Since the early 1900s, June, on average, the month of June is down 0.01%. Now, last month it was slightly up as we ended June, but June historically is pretty flat, and we saw that again. And very volatile as we saw with Brexit, right? July is actually typically, it's typically a pretty good month at a 0.9% average return. August is usually a flat month at 0.01%. And then September is one of the worst months of the year at a down 0.5% average return. And so looking at and understanding what and how the market reacts on an average year helps you prepare psychologically for what may happen. So I would say this. I would say expect volatility moving forward. We're not out of the woods yet from volatility. That doesn't mean you sell anything. That just means expect more volatility in your portfolio. Because you need to understand that as you expect more volatility, as more volatility comes into the market, that's the price that you pay for returns. Being able to stomach volatility, September, maybe a little bit of in August. We might see it in July. Heck, normally it's an up month, but you never know. That volatility is the price you pay, and withstanding that volatility is the price you pay for returns. So keep that in mind. Now, that said, that historical look back in mind, let's take a look at where we are year to date with the sectors, S&P 500 sectors. Year to date, there's utilities, which is up 22.16%, and trading at an average of 150% of book value. So very overvalued, that sector, but doing well. The other two sectors that have done well are energy and consumer staples, both of which we've been fortunate to have investments in. And so those sectors are leading the market. Now, it's interesting to note what's happened the last 3 months. So the last quarter, we saw a couple sectors do very well. Energy did very well, right? Coming off of the bottoms. Most of the year's returns in energy came from the last 3 months. We also saw consumer staples come in. We look at real estate and good returns in real estate, which is towards the bottom of your screen. We find that most of our clients have a lot of exposure to real estate through other investments. We don't invest a ton in most of our portfolios in it, but it's done well this year. But the two stars are those two sectors that we're probably the most overweight. We have investments in energy, we have investments in some financials, but healthcare and staples, which had a great 3 months, are defensive names which we are overweight. Now, that's not a recommendation for you to get overweight, but that's where we currently are as far as our portfolios go, and probably where we'll be for the next several months. So that said, part of the reason why those sectors have done well is because of the fear that's in the market. And the media helped drive the fear up in a big, big way this summer, and it's a new story every summer. You can look back, and it's a new story every summer, but this summer it was Brexit. So far, Brexit, right? And a couple things around Brexit. You're looking at an S&P 500 chart. And so right there on that arrow was when Brexit result came out. And the futures were trading down significantly. So we knew it was going to be a tough open, and it was. The S&P 500, in 2 days went down 6%. And if you look just to the left of that arrow, you'll see a big white candle, and I can point to it with my mouse. That day, the market expected the UK to stay in the EU. And so everyone was happy, and everybody was good, and the vote looked fine. And then, boom, it came out and tanked 6% in 2 days. Now, let me show a different arrow here. That is what we look at as an opportunity. That's how we view it. Anytime you get a 6% down move based on some stupid media-driven fear-mongering story, that's when that opportunity comes in. And so that at that moment, that's when you look to put any cash to work. Maybe not all your cash, but certainly some of your cash. That's when you sell puts, which we did a ton of. That's when you buy stocks and you take advantage of that opportunity. And you can see what's happened since we have taken advantage of that opportunity, and since the market sold off as far as Brexit goes, the market rebounded. And in 4 days was trading right where it was before the result even came out, which tells you how crazy the market can be. Here's the key. You have to have a game plan. You have to go in saying, if this Brexit vote is bad and the market tanks, I'm going to buy this, this, and this. I'm going to sell puts or look to sell puts on this, this, and this. And then you have to put it into play and you have to implement it, right? And that's what we were fortunate to be able to do. And I hope many of you were able to take advantage of that opportunity. Certainly some clients did. So that was Brexit in a nutshell. Brian and I recorded a whole other video on Brexit that you can look at on our YouTube channel. You should have received an email for it. Take a look at that, and that will provide even more thoughts on Brexit as it stands. But the last thing that I wanted to leave you with today, which was fascinating to me, I was on an early morning run the other morning and listening to a podcast, and this podcast was Malcom Gladwell, and he has this new podcast out called Revisionist History. And there's, I think it was episode 3 or 4 that I was listening to, called The Man Can't Shoot, about Wilt Chamberlain and his struggles at the free throw line and how he actually had one good year of shooting free throws, and from then on out it was horrible. And that's not what I want to focus on, is Wilt Chamberlain. But Malcom Gladwell recounts another, just an interesting facts regarding the NFL and Richard Thaler, who's a popular economist. And Richard Thaler did, a Chicago guy, did all sorts of extensive research on the NFL draft and actually consulted with many NFL teams, with 4 or 5 NFL teams, including the Redskins, which he cites. But here's the interesting thing that he found, and then I'll explain how it relates to investing, is he found that looking at the value of first-round draft picks versus second-round draft picks, the value on a one-to-one basis was about the same, right? Value being what do you get on the field and what are you paying that particular player. The value, meaning your return, was about the same. Here's the interesting thing, though. He found that people don't value the picks the same. In fact, for every first-round draft pick, you can trade and get, on average, 6 second-round draft picks. And so you're trading an equal value and getting a whole lot more. I mean, you're 6 times your return, if you think of it that way, by trading a first-round draft pick for 6 second-round draft picks. He then went on to go one step further, and he said the best thing for NFL teams to do would be to trade their first-round draft pick for 6, 7 second-round draft picks the year after. Think about that for a second. Think about the value, just as in terms of value. He also said that an NFL team, just by doing this, can win on average 1 more game per year. And I guess the closest, as he cites, the closest example we have of that is the New England Patriots, as much as that hurts me to say. They've probably done this as well as anybody, and they're constantly winning. But think about that for a second, how no NFL owners ever do this. He talked about the Redskins, and he consulted for the Redskins, and they did the exact opposite. They traded many, many second-round draft picks for several years in a row to move up 1 or 2 slots in the first round. Insane what these NFL owners do in terms of valuing draft picks. But I would say this, it's insane in the stock market world as well. Here is what overpaying for investments looks like. These are the famous FANG stocks, right, that carried the market last year. The PE ratio, so on the left you'll see the stock or the index, the bottom is the S&P 500, but you'll see their current PE ratio, which tells you from a price to earnings how much those stocks are going for. The higher the number, the more expensive the stock. Start at the bottom. The S&P 500 is about a 19.5 PE ratio. That's the market. These stocks, Facebook, 70, Amazon, almost 300, Netflix, 333, Google, the last of the FANG stocks at 29, which is arguably the best value that you can get as far as any of these FANG stocks go. But people go bonkers. They want Netflix, they want Amazon, they want Facebook, and they'll pay whatever price they have to get it, regardless of how bad they're overpaying for the stock. Just like NFL owners in the draft, right? It's just an interesting psychological way that the market gets you, and you have to own Facebook because your neighbor owns it, right? Or somebody else owns it, and you start chasing returns, and that ultimately is where you get into trouble. In fact, at the bottom of your screen, you can see what we believe is the key to making money and managing risk is your ability to buy good businesses at attractive, cheap prices. That's the key, right? And that's what NFL owners don't do regarding the draft, and what many investors don't do as well, for fear of missing out, for fear of your fans being mad at you as an NFL owner, the fear of, hey, I've got to own Netflix, it's the only thing going up right now. That's where people get into trouble. Now, that said, that's one of the 6 mistakes that people make that can destroy your wealth, right? You can check out the other mistakes if you go to that URL, igga.com/6 mistakes. It's a free ebook. We'll send it out to you. That's one of the mistakes that we talk about in quite a bit of detail. So go to that website, click on that PDF, we'll send it to you, and you can see what those other 5 mistakes are. If you have any questions for us, there's my email address, brett@igga.com. There's my partner and value portfolio manager extraordinaire, Brian Huntsaker. Feel free to contact him with any questions that you may have as well. And remember this point, relax. We can take it from here. Thanks, folks.
This is a purely public broadcast and is not intended to be personalized financial advice for any individual's specific situation. Each individual's financial situation is unique, and the topics discussed on this broadcast should not be relied upon and or considered as personalized advice. Specific financial securities discussed are not intended to address any listener's particular financial situation and should not be considered recommendations. This is for educational purposes only. For more information, please contact Iron Gate Global Advisors at info@igga.com or by calling 888-591-0334.